Hello there, Chip Nellinger with Blue Reef. Want to talk a little bit here about changing your expectations and having a plan B as it relates to your risk management plan. Um, as it relates specifically to the corn market here recently, most of our row crop clients rely pretty heavily on the corn market, the corn crop, as their primary revenue driver on their farm. Now, they may be 50-50 rotation, planting half corn, half beans. They might have a little wheat in the process, but very typically, as you look across those crops, the corn market and corn offers the highest profitability for those operations. So we just recently had on Monday, January 12th, the January crop report. That's the final crop report we get for the year as it relates to production yield changes and estimates. That crop report really came out in hindsight after some thought here. I've been involved in the markets for 30 plus years, 31 years, 32 years now. In my opinion, that was one of the most bearish reports that we've ever seen in modern history, anyway, since I've been doing this in the grain markets. From lots of different perspectives, we saw an increase of 1.3 million acres on the harvested acreage estimate since the end of June, starting July 1st on the July crop report. We've seen acreage increase by 4.5 million acres, by far, by multiples of about 300%, the highest increase in acreage that we've ever seen. The market fully expected, as did we as a firm, for yields to go lower. Almost every client we talk to in every state that we deal in, very few customers had yields as high as a year ago. Many were off 5 to 20% on yield. So we really felt going in that the market would see slightly lower yield numbers. They went up a half a bushel to a new all-time high record yield, almost 6 bushels higher than last year, which was the previous largest crop ever. So from a lot of standpoints, shocked the market. The market was down sharply after that report, not quite limit down, but 24, 25 cents lower. It was really a kick in the guts. It really took the air out and made you gasp for air for a minute, saying, "What just happened?" And so some of this is psychological. Some of it is, how do we adjust? How do we go to plan B? Prior to that report, corn market hadn't done much. It had been about a 4.5, 5 month trading range. We were right in the middle of it. But what makes it a little more tough to swallow is that the Friday before the report, the day of the report comes out at 11 a.m. Central. So the market has at least a couple hours of trading ahead of the report being released. We were really just kind of flirting around at some new highs, getting up towards and above the 200-day moving average just by a couple of ticks. Really, we were on the verge of the funds likely kicking in a buy program into the first quarter of 2026 and giving us opportunities at some of the best levels that we have seen in over a year. And then the report came out, total out of left field, total shock to the system, sharply lower. That's the sign to say, all right, let's not stick our head in the sand. Let's not, complain and be mad. We can do that. I don't agree with the acreage. I don't agree with the yield, but it doesn't matter what I think. Those are the numbers that the market's going to use going forward. So that is the new reality. Based on that new reality, what do? We have to look at the charts and figure out where could a potential low be here as far as support. As it stood, about 410 was the previous contract low. We haven't seen that yet, but that's going to be key support on the downside. Assuming that's within a few cents of a low, what could that mean on bounces going forward? We know from history, no market moves straight up or straight down. There's corrections along the way, and there's opportunities from a counter trend perspective to see moves against the prevailing trend. Trend is now lower. Yields there surplus of ending stocks. So what do we do now? We have to be realistic and say, what is the new target zone? What are our new levels that we're going to have offers working and reward bounces as we see them? Don't get stuck in the fact that, hey, we thought before the report we could see some 470, 480 type numbers, and we had offers working up there to sell the rest of our production. That's not in play anymore. So don't stick to that. Don't stick your head in the sand and say, hey, it's 470 or nothing, because we're likely going to run into a lot of resistance between 430 and 445 now. Those numbers might not work as well. They may, in fact, be a negative return for people. It may not offer a lot, if any, profitability to producers out there, but that doesn't change the fact that we need to reward those rallies going forward, because we're here in early January. These are old crop bushels that we're talking about. Most people have a window where they need to get that crop moved by, say, April 1st. Some people hold some crop out into next summer. But from a cash flow standpoint, turning that crop into cash, most people have a limited window here. And so our window is a little bit tighter now. And obviously, we had different news affect the market. So it's a psychological battle, number one, and it's an exercise in changing our expectations, going to plan B and being realistic about where we need to put new offers. Now, from a new crop perspective, the next year's crop, we got a lot of time on that. Probably is going to affect this crop, and this crop report's probably going to affect potential out into next year as well. But we've got a long growing season. We've got South American production that is still ahead of us that could affect the corn market. So just an example of the psychological pitfalls of this market. It's easy to go back and say, we woulda, shoulda, coulda. Why didn't we sell corn before the crop report came out? It's easy to do that because we don't know now what we knew then. I should say the other way. We know differently now. We were faced with different market information than previously known. So we can't go back and beat ourselves up and say, well, why didn't we sell the highs a year ago, December, which was 479 3/4? Well, for one, that was 18 months ahead of harvest. That's a long ways. Most people don't like selling that far in advance. It's hard to do because we don't know what our cost structure is necessarily. We don't know what growing season weather is going to be. We don't know what our production potential is. So to get a lot priced right there, which wasn't even very profitable at that level at the contract high for December 25 corn, it's easy to beat ourselves up about that. But the market knows a lot more now after the release of the January crop report than it knew prior. So let's not get hung up on the fact that, we might have missed opportunity where our target levels were too high. It's really, really important to change our frame of reference, not get stuck in the past. The market was given new information. We need to react with that new information and not stick our head in the sand with lower price levels and pretend like everything's going to be all right, because it may not be. We may need to go to plan B, and it may be at price levels that weren't as high as we hoped. May not be even towards profitability, but it may require action regardless. So very important, hard to do. Hardest thing in the world to do is to sell a market that's already off the highs and looks like it's going lower. But if we're patient enough, if we have targets at logical points on retracement levels, old lows, which previously were support, which are now resistance, different Fibonacci retracement levels. If we can line some of those up, be patient, reward those bounces in a bear market when we see them, it can really pay some dividends and add some value to the bottom line. Don't hesitate to reach out here. Contact information is below. If you have any questions, comments, happy to talk to you. Thanks.